Hey, morning, everyone. Thank you for joining us for today's Phillip Securities Research Morning Call. I'm Wee Kwang, and today we will be covering 5 stock counter updates, as well as some macro and sector outlook, including the REIT sector, as well as the banking monthly, and then followed off with the Singapore weekly. Okay, so first off, I'll be starting with the Singapore banking monthly. We are actually downgrading the Singapore banking sector from overweight to neutral. For those who are not caught up with the results yet, for the first quarter of 2020, we can see that across the three banks, earnings actually fell between 19 to 43%. However, what we see is that if you look at just the total income as well as the pre-provision operating profit, generally the banking operations were largely unaffected during the quarter, with UOB having a comparable results to first quarter of 2019, and DBS seeing robust growth across all its business segments of more than double digits. For OCBC itself, its PPOP was largely affected due to the contribution from Great Eastern Holdings, with a poorer investment market in the end of the first quarter, resulting to lower shareholders' funds and investment holdings. So as a result, what we see is that for the third row of the table, the allowances allowances for the first quarter is actually the determining factor in why the earnings were much poorer compared to the same period last year. So, and if we were to look at some of the funding, liquidity, as well as capital positions of the banks itself, generally, when compared to the regulatory requirements by MAS, all of them are pretty healthy and well above these requirements. So as of the first quarter of 2020, we don't see any signs of stress for the banks yet. However, some of the investors may be worried about moving forward, what might be the outlook. So first off, when we look at the interest rates, we see that actually the interest rates has actually been under pressure. So previously, during the previous banking monthly, what we saw was some resilience during the March SIBOR and SOR rates. But however, over the past 2 weeks, what we saw is that if you see in the graph in the middle, what happens is that the 3-month SIBOR and SOR actually fell quite steeply to 0.69% and 0.26% respectively, which is comparable to 2013-2014 levels. And during those periods, as we can see on the table to the right, the NIM for the three banks were actually about 10 basis points, about average of 10 basis points lower as compared to where it stands now in the first quarter of 2020. So what happens is we are taking this into account, and we will be reducing our NIM estimates across the three banks by 10 basis points for the entire 2020, which will equate to about 5 to 6% impact on the net interest income, and which makes up about roughly 65% of the total income of the three banks. Then we look at the loans growth. We see that loans growth actually tapered in March to 2.41% year-on-year. So consumer loans fell 2.43% year-on-year. In particularly, we see housing and credit card loans seeing a steeper decline, and while business loans actually holding up the entire loans growth. So coming in at 5.52% year-on-year. So when we see the table at the bottom, the 2.41% year-on-year growth is actually the slowest in about past half a year. So, but however, for the entire financial year of 2020, we expect loans growth to remain within our estimates of 2 to 3%, and especially when the government has come into play to help support lending by the banks. Taking a look at different sectors, so the equity, the capital markets, what we see is that actually volatility fell off from the March highs. We also see that derivatives is experiencing some fatigue. So what happens is for the month of April, actually the derivatives daily average volume, fell 19% year-on-year. And this is compared to double-digit growth over the past 3 months. So even compared to the first quarter, is a big drop as well as a drop year-on-year. So what happens is that on the other hand, what we see, the securities market actually remains more resilient. What we see is that for the SDAV actually fell off the peak but remained at a heightened level. Even in April, it was a 35% year-on-year increase. And even for the month of May itself, what we see is roughly a 20% increase year-on-year. The general trend is that institutional clients are still selling, and retail clients are still the ones doing the buying. And if you were to look into particular sectors, the institutionals are actually offloading financial stocks, while the retail clients are actually buying up the financial stocks and some REITs and financial stock. So as a result of what we see in the market right now for the banking sector, we are expecting earnings, the earnings impact from COVID-19 for the financial year 2020 to come in at around 20-30% of the earnings. As such, we have also revised our target prices for the 3 local banks by adjusting for NIM compression as well as the increased credit costs as the banks take on more and more allowances over the next few quarters to combat the COVID-19 pandemic. Currently, we are having a stronger preference for DBS due to their stronger business momentum, using their top line to pull up their bottom line to reduce the impact. What we see is that their commitment to dividend that is more pegged to the operational performance rather than a targeted payout ratio or CET1 ratio also makes it more attractive for investors who are looking for yield during this current market condition. And that's it for me for the banking sector. I'll now pass the time to Jie-Hui, who will be talking about IREIT Global.
Thanks, Mikon. Hi, I'll be going through IREIT's first quarter update. Okay, so IREIT has shifted to semi-annual reporting, and the next result announcement will be in June. We are expecting stable results given that 100% of their rents are collected in first quarter, and they have collected 98% of their April's rent, which is supposedly the month that is most impacted. We are still expecting continued stability as lockdowns ease post-April in Germany and Spain. Additionally, the manager has proactively secured a 9-year future lease for the entire 2 floors, which GMG gave out on for Munster South building. As the lease will commence right after this break, we are not expecting any dip in occupancy from this transfer of leases. Lastly, PhillipCapital and CDL increased their unit holdings to 29% and 21% respectively, along with the new shareholder 80 Investments, which acquired a 5.5% stake in IREIT. Collectively, they will own 55% of IREIT shareholdings. Meanwhile, Mr. Bruno purchased 200,000 units of IREIT at 61 cents. These transactions are testaments of the sponsors, investors, and managers' confidence in IREIT's portfolio. For the negatives, we see limited growth from the portfolio as rental escalation for most of the leases are linked to the nation's CPI. 2020 DPU is also expected to be impacted by the depreciation of USD in 2019, given that IREIT hedges most of its repatriated income 1 year in advance. In terms of outlook, amidst COVID, the German portfolio has been vigilant as the manager has not received any requests for rental rebates or deferrals from the German portfolio. However, there's been a few from the Spanish portfolio, and these tenants contribute less than 2% of IREIT's total income. Office income and leasing activity are expected to slow across both European states as tenants and investors are more cautious towards relocation expansion. Since occupancy rates for the German and Spanish portfolio are almost at 100% and 81% respectively, the lack of leasing demand is more concerning for the Spanish portfolio, which today IREIT owns 40% stake. Nevertheless, IREIT's portfolio presents defensiveness given that 95% of the income stream is locked into 2022. Overall, we agreed to buy with a lower target price of 77 cents. We revised our COE assumptions upwards by 80 pips and DPU estimates downwards by 1 to 3% due to increased market risk and lower rental growth assumptions. That's all from me. We'll be moving on to the next.
So I'll be presenting on EC World's 1Q results. For EC World, 1Q revenue and DPU came in 18% and about 27% below our forecast due to the one-off 23.7 million renminbi rental rebates given to tenants. So this translates to about 4.6 million Singapore dollars. And also DPU was lower because of a 5% retention in distributable income. Excluding these two events, revenue and DPU would have been in line. So as you can see from the table, 1Q gross revenue actually fell by 1.4%. However, this is not actually representative because in September of 2019, EC World actually acquired, rental, okay, so due to the lower rental rebates, the revenue actually fell. Another thing to note is that EC World also will be has from this quarter on, EC World will be changing their number of the units management fee paid in units from 100% to 50%. So this will affect our DPU estimates going forward. On the positive side, income visibility, there's high. We like that there's high income visibility due to portfolio occupancy of about 99.1%. However, do note that this is about 0.9 percentage points lower quarter on quarter. WALE is also relatively long, at 3.8 years. So 74% of FY20's revenue is secured through 4 master leases to the sponsor, with built-in rental escalations ranging 1 to 3%. Another positive is that the running cost of interest rate fell quarter on quarter from 4.4% to 4.3%, and this is likely attributed to EC World increasing the interest rate hedge in 1Q from 72% to 100%. On the negative side, the accretion of Futsal e-commerce was wiped out. So actually, this asset will have contributed $4 million to 1Q revenue. However, as you can see, the revenue actually fell. We also note that the trade receivables ballooned by about $18.8 million. So this is roughly a 51% increase quarter on quarter. It indicates that about 80% of 1Q's revenue has not yet been collected. So given that the sponsor actually contributes about 74% of revenue, this increase or ballooning of trade receivables actually implies that some of the trade receivables that have accrued are actually attributed to the sponsor. So that being said, there's no trade receivables past 180 days. So we actually lower our TP in FY20 and 21 by 5.6% and 3.9%. This translates to a DPU of 9% and 9.6% respectively. So we actually also, apart from the adjusting for the 50% units, management fee paid units moving forward, we will also be we also increased our cost of equity to incorporate a higher market risk. This is our REITs monthly. Okay, so this is just to show take stock of things. Since the crash, the different subsectors have performed differently. So we see that the more resilient ones are the healthcare and industrial. They only fell by about 33% and 35% during the fall. The worst hit was actually hospitality, fell about 53%. So somewhere in the middle, we see retail as well as commercial that fell about 38%. So in terms of recovery, healthcare and industrial, they have recovered roughly 55 to 59% of their share price of their drop. And then retail commercial somewhere in the middle, then followed by hospitality, which only recovered about 20%. So this is another chart to show you where we are. Dividend yield is about 5.4% currently. This compares to average dividend yield of 4.6% in 2019. Dividend yield spread currently at 1.4%. This is a major improvement compared to 2019, when yield spreads were in the -1 to -1.5 standard deviation range. So impact to subsectors. The impact to subsectors differ, and it varies largely, first of all, on the tenants on the underlying tenants' reliance on the premise to generate income, and that will affect the degree of business disruptions and the amount of rental assistance that has to be rendered. And lastly, the future demand for space after considering all the behavioral shifts that have been set in motion, such as e-commerce and telecommuting. So the table on the left actually shows you the percentage of tenants operating within the subsectors. So for hospitality, about 40 to 80% across the hotels and SRs. For retail, only 20 to 25% of tenants are operational. Commercial, about 10 to 30%, and industrial, about 60 to 70% across the portfolio. And in terms of rental rebates, retail is the one that offered the most rental rebates, about 2 to 3 months. And for commercial and industrial, selectively to their tenants, about 0.5 to 1.5 months. So what we have noticed is that the leasing activity has slowed, and due to the lockdown, it was physically difficult to show the spaces. So what the managers mostly got were renewals. And moving forward, due to we also noticed a higher vacancy rate. This vacancy rate was higher vacancy rate was noticed across retail as well as commercial. Not so much in industrial, and also lower rent. We expect lower rents or even negative rental reversions moving forward. So the mitigating factor is that tenants are actually locked in by their existing leases, and there is actually very little supply coming online across the subsectors. So now we dive into our subsector views. So for the retail subsector, we actually noticed occupancy dipped by 0.5 percentage points, while the rental index fell by 2.3%. Also, due to the COVID outbreak, we actually noticed that a lot of retail tenants have actively engaged landlords and their respective trade associations to request for more rental aid from their landlords. And so that we're noticing that the market's actually expecting for landlords to have more skin in the game. And since there's a high reliance on premise to generate revenue, this was the sector that was the hardest hit by the lockdown, and also highest rental rebates were offered 2 to 3 months. So moving forward, we actually expect the landlords to actually embark on more flexible leasing strategies by allowing shorter lease terms as well as higher risk sharing. In the long run, this higher risk sharing may actually increase the demand as the lower fixed rents make it more economically viable for new to market brands to give the brick and mortar model a go. So for the office subsector, occupancy dipped by 0.5 percentage points in 1Q to 89%. And the rental index also fell, but fell less than in the retail index, retail rental index. Occupancy for office fell by, retail index for occupancy for office fell by 1.3 percentage points. Not shown in this graph is the office prices that also showed some weakness. It fell by 4% quarter on quarter. So there's actually a low reliance on the premise to generate revenue for the tenants. As such, these tenants were actually able to telecommute and operate normally from remotely. As such, there was not a lot of rental rebates that were offered to the tenants. So on the positive side, there's actually mixed. It's still relatively early to see how the counteracting leasing strategies will play out. So on one hand, the successful implementation of telecommuting is likely to have a long-term impact on the occupier strategy, and it poses risk to office demand. On the other hand, we may see companies choosing to reduce over-concentration risk by adopting lower desk densities and splitting offices. Hence, that will increase the demand for office space. So overall, we still do not know how this demand for office space will play out. So for the industrial subsector, this is relatively resilient for now. Occupancy is unchanged quarter on quarter at 89.2%. The rental index for business parks is unchanged as well. But for multiple and single user factory and warehouses, the index fell by 0.2 to 0.4%, so slightly. And due to the several asset classes within the industrial subsector, we see that business parks have the lowest reliance on their premise to generate revenue. So these tenants in business parks they use their space quite similarly to office tenants, and hence, however, we see that also for the light industrial high spec factory warehouses and data center asset classes, these assets have a higher reliance on premise to generate revenue, but we're actually comforted that for those assets that telecommuting is not possible, such as your light industrial and your factories, warehouses, these asset classes actually had a relatively high percentage of tenants that were operational. So REIT shared with us that in the factories and light industrial assets, about 90 to 100% of tenants were operational during the first month of the circuit breaker. And that actually gives us a little bit of comfort as to the extent of business disruption and the amount of rental rebates that the tenants may actually request for. So the risk to this sector is that there's actually a relatively high percentage of small medium enterprise tenants within these assets. And the potential positives for this sector is the heightened demand for logistics as well as data center assets. For hospitality, this is no surprise. Hotel RevPARs fell by about 62% year on year, and average occupancy was 40% for 1Q 2020. So there's also a high reliance on the premise to generate revenue, and the extension of lockdowns in other countries, as well as extension on travel bans, will keep occupancies at depressed levels. So the silver lining is that there have been alternative sources of income. So these are block bookings by the Singapore government and self-isolation, as well as overseas. There some hotels were used for or were rented to actually house first responders and medical healthcare professionals. So the lingering fear and the caution, even after international travel bans are lifted, will actually continue to depress the hotel occupancies. And in the meantime, domestic demand might actually help to supplement the occupancies or lift the occupancies. So this table actually summarizes the changes that we have, or rather the adjustments to our forecast and target price. So in the first column is the previous FY20 DPU and then the new FY20 DPU, and then followed by the previous FY21 DPU and the new FY21 DPU. So overall, we have reduced the DPUs in FY20 more sharply than in FY21, and our target prices have been largely lowered. However, if you notice in the last column, DPUs are depressed in 2020, but they actually, due to all the rental rebates that have been given, especially for your hot retail and retail like assets or retail REITs such as CMT and FCT. But then in FY21, there actually will be a slight increase in DPU yields. So that's all for me. I'll pass the time on to Paul.
Okay, thanks Natalie. This Paul here. So I just have 3 results to run through and our usual Singapore Weekly. So for PropNex first quarter results, the earnings tripled, but I think the outlook is pretty cloudy, especially coming from management. Next slide. Okay, if, on the results, if you look at the table on the left, you can see that the earnings or PATMI profit rose almost 3-fold from 2 million to 7.6 million. The main driver was been the other box, the red box, the project marketing, which is essentially new project launches. The other surprising was the private resale. This is basically secondary transaction, or your resale market for private. That also surprisingly rebounded strongly. Okay, in terms of the positives, obviously the 3-4 jump in earnings is a positive, mainly due by new project marketing or new sales. But do note that what we see now in the results is due to good sales that happened 8 to 12 weeks ago. Because it will take time for the, once you book a sale, you need to settle, sign the SPA, then you collect the commission. So it took like 2 to 3 months before. So whatever bad numbers that we, transaction numbers that we see in this quarter, which is this current April, due to COVID and so forth, you probably only see it in the, let's say, fourth quarter or fourth quarter kind of, in the third quarter kind of results. Okay, the other positive is cash keeps piling up. The net cash for this company, actually there's no debt, so it's all cash. It's almost 90 million. So this is almost 50% of the market cap. Okay, capex for the first quarter was actually nothing. I said they'll probably spend on maybe 5 laptops or something. And I'm just kidding, but it's less than 100,000. Okay, the good thing is, good and bad, of course, when the revenue picks up, then you get a big operating leverage. I think you can see that the revenue almost rose about 80%, but in terms of the salary, they only took 1 additional headcount. So you can see that most of it is third-party agents that they rely on. So there's no cost on their books. Okay, in terms of virtually no cost. In terms of the outlook, it was pretty bleak actually, the outlook. This is management's outlook. So in terms of new launches, which is new property launch, first quarter was good, 17% rise, but I think so it will help in the coming quarters numbers. But what they say is that they're looking at almost a 20% drop for this year, which is quite pessimistic. This is worse than, if you recall in July, when the authorities tightened the property market, raised stamp duty and so forth. This is probably worse than that 12 months level. And then in terms of the resale, which is some secondary market, the volumes actually improved in the first quarter, 12%. But I think this segment of understandably would be worse. That in terms of transaction in the secondary market, will be worse than new launches. I think what is happening is the buyer behavior. That's the main reason. I think as you can see now, without the viewing the units, if you buy a second hand on a secondary market, there's a higher risk if there's any issue with the units. Whereas if you buy from developer, you still have a 1-year defect warranty. So surprisingly, even without viewing, some people still buy new launches. Don't ask me who are they, but there is some who still buy. But of course, secondary is harder because you have to rely on the person selling and you're never sure of the quality. So anyway, the expectations are 30% drop. I'll quickly move on. The HDB resale will be a bit more stable because this is a need-based buying, so it will fall about 10%. We still maintain a buy. Of course, we lower our target price because we cut our earnings. But what we see is that the company still wants to be a high-paying stock. So we think that they can maintain dividends. So assuming they maintain 3.5 cents, the yield is about 7. And the reason why is that to maintain 3.5 cents, you only need about 13 million. And as we mentioned, they have 90 million on the cash. So I think even if they don't have any revenues for the next 1 year, they can more than enough to cover the dividends. Also for Comfort, really the conclusion, it's not a result, it's just an update. It's really pain everywhere. Every division overseas, Singapore, that's painful everywhere. Okay, next slide. Okay, in terms of the results, okay, they don't give a full set of results, they just give an update. So you can see that the PATMI dropped about 50%. You can see on the table on the left, profits dropped 50. Okay, anyway, I'll just run through later the details. Okay, in terms of the positives, the good thing is that the cash flows were actually strong. They generated about 105 million cash flows versus a year ago, 95. And they actually turned into a net cash position compared to the net debt end December. Okay, the negatives, the main one, the main pain point is of course taxi. Taxi of profits plunged 92%. As you can see from the red box here, I think almost nothing. I can assume it's breaking even. Okay, it dropped 92%, mainly because of the rental rebates. And obviously it will be worse in the second quarter. In total, Comfort is giving about 116 million rental rebates. Rental rebates means they just don't charge the taxi driver. Just a reminder, as you know, the model for Comfort is that all the taxi drivers will rent the cars from Comfort. Then the drivers will just drive around and they'll just pay, let's say, 110 every day. Whether have passenger or not passenger, that's the taxi driver's risk. Okay, but anyway, so they actually give rebate. That means they're not going to charge the taxi driver. So only 13 million we think was incurred of the 116, and we'll show you a table later. So the big one will be 70 million in the second quarter, this April quarter. So you expect even worse results in the second quarter. The other thing is bus operations. As you can see from the public transport line here, the 653 million. Inside here is bus revenue and also rail. Bus is better because bus you just have to, like we always say, just drive in circles. I keep driving in circles, no passenger, never mind. So because the authorities will just pay you for mileage driving in circles. But of course, it is not immune. There is some cutback in the mileage, so this will impact the revenues. So in terms of outlook, taxi will be bad, and I think because they got 100% rental waiver from 7 to, that means Comfort is not collecting any revenue off on the taxi drivers from 7 to 5 so you can know the pain point this will be. And they expected to be loss-making. Public transport, the most recent update during the circuit breaker, volumes are down 70-75. And of course, rail will be hit, the train, because there is no, they take the passenger risk. And even bus, I think bus will be less impacted because you still need to have some capacity out there. Okay, we downgrade to neutral. Again, it's very challenging stock for us because even after the circuit breaker is over, you still have social distancing behavior, work from home, decline in tourists, and all this will weigh on all the volumes. We slash our profit by 60%. Okay, this is just a table. Comfort made many announcements. Sometimes it's so hard to track. But anyway, on the 13th, just to let you understand how to read this. So the figure one, the table on the left, on 13th February, they announced $10 to relief per day for the driver. Then of course the government has another 10. Then they increased to 16. Then in 25th March, they increased it to 10. Then I think by 4 April, they just gave out. They just give 100% rental rebate to all the taxi drivers and then extended it. I think that this week, because it's coming up 1st June, I think they might announce, I'm not sure what they're going to announce. They could extend or maybe increase it. I'm really not sure. This is just to give you the 116 million. This is how we estimate, and they don't give details of this. This is our own estimate. And the second quarter, as you can see, the 68.9 million. So the full hit of the rebates will happen in the April quarter, which is this coming quarter. Okay, next. Move on to ThaiBev results. It's basically, as the title says, there's a real short term, there's a really alcohol consumption going to be curbed in the very short term. Okay, next slide. Okay, if you look at the table on the left, just a reminder, for ThaiBev, the main part is the spirits business, which is brown spirits, somehow like a whiskey, that sort, and beer. So what hit the business is the beer. You can see the 23% drop. The volume down 28, which is quite a tremendous drop. I mean, this beer, right? Who actually stops drinking beer? 28%, right? So anyway, And tobacco was the one that was the worst hit. Beer means Thailand. This 28 is Thailand and Vietnam, but tobacco, which is the Vietnam, dropped 40%. So obviously that was the reason why nobody wants to drink beer. We'll explain later. Okay, so that hurt the earnings. The earnings were down 14, but there was actually a one-off deferred tax. So actually the earnings was technically flat. Okay, so anyway, I'll run through again. In terms of the positives, what the positive was that margin was stable. Spirits was stable, the margins, because what has happened is that although revenue is down, they actually cut back a lot on their distribution expense, the advertising and so forth. That helped the spirits business. And that's why you can see on the table on top, the spirits, which is like 5.3 billion, 35 billion, the profits was actually up 9.5%. Because they actually managed to cut down some of the costs, because a lot of these are kind of discretionary. Beer, of course, collapsed. Okay, and then the negatives, Sabeco is their Vietnam beer business that they bought. And what has happened is that there are three pressure points for Sabeco. First, initially there was some fake news that affected volume, saying on the ownership. Then this big one came out, which is the Decree 100. I mean, initially we thought Decree 100, what happens is that they will introduce stiff penalties for drink driving. Initially, we didn't really think it would be so tightly kind of implemented, but it was. And what's happened is that you can only drink with 6 to 9. Then you get very stiff penalties if you are caught drink driving. So that has hit a lot of this so-called on-trade. On-trade means people drinking in pubs and clubs. The other part is off-trade. Off-trade is not you drink at home, which is more the spirits business. So as a result, you can see that that's why it went to a loss. In terms of the outlook, the second quarter will still be weak. Because what will happen is that on 10 to 3rd May, there's a ban in alcohol sales in Thailand. It's back to, it can be sold right now, but I think up to the 3rd. So you're going to lose these 3 weeks of sales. So this is going to hit the coming earnings. But spirits business, which as you can see on the table above that 5.35, it accounts for most of the profit, 80-90%. And most of it is consumed at home. So it will be less affected on a more medium-term basis. Sabeco will still be the problem. So we maintain our buy. We will still cut our target price. But again, we still like Thai Beverage. I mean, their spirits business is 90, but they command they control the whole market for spirits. And just to give you some flavor of how dominant they are, they've got almost 280,000 point of sale presence and another 150,000 covered by agents. So another lever for them is that they can cut advertisement and promotion. So it will be sluggish, but we still like this stock because of the valuations, and we actually lowered our target price. Okay, this is our usual, just our Singapore tactical weekly update. Next slide. Okay, in terms of some of the more meaningful macro numbers was the Singapore exports. I'll show you a chart later on all this, but the exports was surprisingly strong in Singapore for April. It was up 9.7%. The amazing one was the pharmaceutical and chemicals that saw a dramatic rise, but this is very volatile. In the US, we get some flash PMI, which is a survey number to look at manufacturing services. It's a survey of all the managers, purchasing managers. So what has happened is that it's actually rebounded. It's still contracting, but rebounded. So you can expect some good numbers out of the US for May. We also looked at SIA since there's a lot of queries on SIA, but we just give you some flavor. We don't cover, but just let you know what's an update. But anyway, there's a 99% drop in passenger traffic. We'll show you a chart. And if you're looking for recovery, if you look at 9/11, again, these are, you cannot, of course, you can never compare 100%, but just to give you some sense of the recovery back to the pre-crisis level, pre-COVID levels. For 9/11 in the US, it took 22 months. For SARS in Singapore, it took 11 months for the recovery. So the recovery for SIA won't be, I mean, on paper, won't be, it will take some time in a nutshell. Our tactical views, we think the market is still going to move sideways. I think the economies will start to heal. Everyone will be will want to see as they unravel these lockdowns, will there be a second wave? There will be, but how serious will it be? So the strategy is really, tactically, is just buy dividend yield. I think that's the only strategy there, especially in this globally low interest rates and record low interest rates. The other thing is that COVID-19 cases is still rising globally, but the good thing is that it is actually declining for some of the large economies. So if this continues to trend down, then I think the economies can heal faster. Okay, in terms of weeks ahead, later 3 p.m. we have the Fortitude budget. Not sure why it's called Fortitude, but I know the Fortitude budget is the 4th support package. The last one was April 6th. So this was on paper, before the the circuit breaker. The GDP number came out today. It was minus 0.6, better than the minus 2.2 that was in the flash. Later on also, a lot of data coming out today. Just one final note, in terms of weeks ahead, we have a few listed company webinars. If you want, just register for them in our programs. We have World REIT, NetLink, then we have Asian Pay TV, which is going to be in poems. We haven't registered it, put it up in poems, so you got to wait a while. And then we have Alliance Healthcare. So if you're interested to listen to any of these listed company presentations, so just go to the site below. Just a few slides for me, then we will end it for Q&A. Okay, this is just some, not because now the predicting the market is almost like predicting the amount of COVID, the path of this outbreak. So in terms of globally, it's still rising to new records. We're still at 100,000 a day in terms of new cases globally. But the good, I mean, not so good, but I think the only kind of more favorable point of view is that the large economies like UK, US, that's trending down, although not very steep, but it's still trending down. So that's a positive that the new cases coming up from these big countries are slowing down. Most of it is now coming in the rest of the world. I think the notable ones, you know, like Brazil, India. So these are the ones that the cases are coming up. But if this red line continue to trend down or even can fall even further, then that will be good for the market. Then we know we kind of like containing it to a certain extent. Okay, this is nothing much. This is actually flash for me and not April. This is just a quick look at what is the outlook for the May, the US economy for in May. This is probably the most updated data point. So there is a rebound in at least business activity for services and manufacturing. Composite means services is a combination of services and manufacturing. So this one tracks quite very closely to the GDP. So you can, that's in a nutshell, April is improving at least for the US economy. Okay, in terms of exports, just very quick, just to show you that surprisingly there's a rebound in exports in Singapore. Next slide. Okay, this is my last slide. Okay, so this is the since SIA is such a hot topic, just to tell you this is the later data point. This is the number of passengers carried by SIA. 99% drop. A year ago was 1.78 million. In April of 20 was 9.2 thousand. Actually, not sure who were these 9.2 thousand actually, but anyway, it's a 99% drop. Almost nothing. I mean, there's no passenger carried. If you okay, then if you want to track how long will there be a recovery, again, this is just a quick update. 9/11, it took 22 months. That means you see the blue line just before that plunge. So for it to recover back to the original levels pre 9/11, of course, there was also weak economic conditions. It would take at least 22 months. For SARS, SARS hit in March, but the traffic, at least from the Changi traffic, dropped in May. And then for it to rebound back to the pre-SARS levels, it took about 11 months. Again, this is just for reference. Doesn't mean you replicate exactly, but this time around it may be even longer because of the severity. Okay, I think that's it for us. We can take questions, but but apologies, we have to end sharply at 12:20. I think because we usually do this on Monday, so we took Tuesday, and then 12:30 there's another webinar going on. So that's why we have to kind of cut short at 12:20. My apologies if we cannot answer everyone's questions. But if you have questions, feel free to type under the Q&A box. Thank you, everybody. Okay, I'll try and do this first. What is your view on SETS in the short and midterm after most international air travel bans? I think they came out with a profit warning. My view is just to avoid it, avoid it in the short and medium term. Really, no idea how the recovery is going to play out. No, unlike SIA, they have government support. I don't think SETS. I mean, of course, SIA is their parent. It's going to be very, very challenging. I just find it so problematic. I rather invest elsewhere if I have to, than to try and pick the bottom for this. It's just so challenging for me. So because as SETS depend on providing food on the airplane and also cleaning up planes. So even if there's a recovery because of social distancing, it will be the recovery will take a long time. So that's why I hesitate to have any favorable views for them in the longer term. The only good thing is that they do cargo traffic, so that helps to a certain extent. But my own view is just to just avoid it for the time being. Yeah, sorry, and this is the best I can answer. Don't have really any really deep insight.
Hi. So I have one question. Is regarding the increase in cap rate. So I think one of my slides, right, I put that according to CBRE's April 2020 cap rate flash rate survey. So this is a survey done by CBRE where they actually surveyed some of their investors, and across the board, the investors were actually expecting retail retail transaction prices to dip slightly, and this was translated into the increase of cap rates. So overall, the band which the retail assets traded in expanded by 30 basis points. So that's what I meant. So so for valuations, right, it's largely a trifactor methodology. It incorporates present value of cash flows from the assets. So what affects this is the rental growth assumptions. It also includes the comparable transactions and as well as capitalization rates. So throughout this period, actually cap rates have remained largely unchanged, given that due to the absence of transactions during the COVID-19 period. However, valuers may actually marginally adjust valuations downwards by incorporating a lower or more conservative rental growth assumption due to the weaker economic outlook and demand. So that is for, in short, right, we actually do think that transaction prices may experience some weakness or some declines. I have another question regarding where did I get the different subsector performance for the REITs? Okay, so this, right, is the chart. The chart was actually, if you can move back, if you can move back the slides to the REIT slides. The chart was actually a price chart. It was done by using the closing prices for the respective REITs within the subsector. So, and then we actually used we actually grouped all the the REITs within subsectors, and then we plotted this. We rebased it against one of the sectors, and then this is how we got the change. This is just basically to show how the REITs have been affected and how much they've recovered by. That's it.
Okay, I've got one question here. What is the direction of the Singapore market in June after circuit breaker recovery in tech? Unless we have recurrence and they put us back into circuit breaker, we think, I think the recovery should be in tech, but it will be very slow. And I think the best way to play this is to buy the malls. I think that will be the most obvious. I think I think that would be the most likely scenario, unless when we touch wood, we really open and then there's a second wave. Apart from that, I think if you want to play this circuit breaker recovery, I think the malls will be the most obvious to tactically play this improvement of the opening up of the Singapore economy, I guess, in lack of a better word. Yeah, thanks. Okay, I will try and take on some questions as you try to gather for the rest. I think there's one on S-REITs. But okay, any views? The next question, any views on the three telcos? Three telcos, I presume, includes Netlink. Our preference is Netlink. I think it's the obvious, the safest. The safest way to collect your dividends, I think, in probably the whole of all the Singapore stocks. If you want to collect a safe dividend, I think Netlink will be the most obvious, hardly impacted by the COVID, but by this outbreak. The only impact is maybe you have to do less renovation and moving a bit of the wires underground. The second is probably StarHub, but it's just that I think the earnings will be a bit sluggish because I think it was a negative surprise to me too. What has happened is that their roaming business is actually much more than I thought. I think it's probably hitting their earnings 10 to 15%. So that, it's almost disappeared overnight. So the earnings will be a bit sluggish. So I'm a bit more hesitant on StarHub. It's still in our Phillip 20, but just that in the very, very near term, a bit hesitant. Singtel, I think just avoid it. I think from the worry we have is that even before we had COVID, they were having a lot of competitive issues in Australia. I think the competition is like escalating in Australia, so that's why I would avoid Singtel for now. And of course, with COVID, it just makes it even worse. Okay, the next one, would you advise to buy the SIA rights? The rights are no longer trading. Anyway, would you advise to buy SIA rights and sell SIA mother shares to profit the difference? Yeah, I think the rights are no longer trading, so I don't think you can pursue that strategy. Vikan, you want to answer this one? Should we cut loss on banks?
Okay, I'll take it. So I think currently for the banks itself, it really depends on when do you enter the market. But generally, I still feel that the banks are one of the most valuable stocks on our stock market right now. If you're thinking of cutting loss, I don't think that the share price will, as in barring another scenario whereby there's a huge short sell down again. I don't really see the share prices going down. I think most of the market has already taken into sentiments of the amount of allowances that the banks will be taking on over the next few quarters. So we are already expecting a poor performance for them over the next 1 to 2 years. But after these 1 to 2 years, when they become valuable again, it really it is really hard for you to see whether you are able to grab the uptrend again. So right now, maybe there will be some weakness in share price. It might not go up a lot, but I don't think that there will be a lot of downside to it as well. And even for the next 1 to 2 years, they are still quite stable in terms of their dividends. At least for the next 1 year, I think you can still hold out unless when we enter into the second year in 2021, when we see that the credit costs are really rising at a much faster rate than expected, then we might want to choose to do something about it.
There's a question for Capital Commercial Trust. What is your view on the merger with CMT? Will the current price affect the outcome of the merger? We also have some questions on the US market. Sorry, we will not go there. I think later Warren has a 2:30 call on for charts. I think you can, if you got any charts on the US, you can actually ask him later. Right, Warren, it's 2:30, right?
Yeah, it's 2:30 to 4. So yeah, I'll see you all there. If you have any.
Yeah. If you have anything on the US chart wise, you can just listen to his call later. You can register on the Poems website, and then you can actually ask him. So he's actually he's very patient, and he will actually try and answer everyone's questions on any respective charts that you may have. Okay. In terms of the other question that we have, we wait for Natalie. I'd like to ask on venture. Is the outlook good to ride the COVID demand for the tech rally? I think the outlook is fair. I wouldn't say it's good. The reason why the first quarter for venture was affected because you actually cannot produce. Malaysia asked you to shut down, right? So we think it should be an improvement, but really strong, robust growth, we don't think so. But we think they will still pay their dividends. I think now it's like 5-6%, if I'm not mistaken. And the thing going for tech is that there's a team going out there right now. I think people are spending less on services and on experiences, basically not traveling. So as a result, a lot more spending that it has seemed to be spent on goods, including electronic devices, to my surprise. So that is one trend that is helping the hardware sector, which should also help venture. But I still think it will be a down year for venture. It won't be a strong, robust year. It will still be a year of contraction. But yeah, so it's a fair stock, but just that don't expect any robust earnings growth out of venture. The reason why we always hesitate right now is because the outlook is really hazy. It all depends on the path of this pandemic. Yeah. Okay, but yeah, anyway, if you've got any questions, you can just send Natalie directly. I think because her audio has problems. We'll answer one last one. What is your outlook on UMS? The outlook looks good this year. I think they have visibility up to the third quarter, so I think it will be a growth year for them. Because I was in their call recently, so it should be a good year for UMS. Yeah. Okay, anyway. So sorry for the technical issues we have. We probably have to end it now at 12:20. But again, if you have any questions, you can always just email us, email our research website, or just go to the Stocks BNB. There's a commentary section. You can ask a question. We will try to help you there. Again, thanks everyone for attending. Sorry we have to end it now because there's another call. Someone taking up this line at 12:30. And apologies for the technical issues. Thanks everyone, and take care. And hope to see you in our listed company presentation.